both of them. So we can have more than 40% savings easily. What do you mean? And this kind of an achievement in a democratic society is a very major achievement. This is not like China, where a large part of the savings is a forced saving because of certain government cuts. So in a democratic society, this kind of a saving is a very major achievement. That's the second thing I want to bring in. Because, why? Why I am saying so? You will need funds for your infrastructure. You will have to pay back. So your country has to generate that kind of money to pay back at some stage. For that you need higher growth, and that growth has to come from higher savings, because it cannot come through largely FDI. Yeah. FDI, the requirement that we have is still very small, as we showed. The difference between investment and savings rate is only 1% or 1%. Now,
Sir, again, if you see the saving goes beyond say 30%, will it have its own negative effects, because the money will not be generating the revenue?
the savings will then get into investments.
Yeah, but
Once it gets into, if you do not have channels of investment here, like say Singapore, where they cannot invest it in the country, they have a very high savings rate. So then you have to find other revenues outside the country. But here we have huge requirements in infrastructure and other places, etc. So there is absolutely no problem. That investment will generate further employment and income.
So but we've seen in the previous slide that investment in infrastructure after 5 years is not that much. It comes down.
Investment is coming down?
No, into infrastructure.
No.
There.
No, there are no funds.
There.
You want to see that slide?
Yes.
I will show you. Okay, let me just finish this, then I will go.
Yeah.
Now, if you look at the income distribution, what is happening is the top end is going to grow. The middle end is also going to get fatter. The lower end will come down. Okay. Now, what does it mean? The standard of living as such will go up. So if you are a marketing man, there's a lot of hope for you here.
Does it take the poverty line into account? This is the entire population.
This is the entire population. Poverty line will be somewhere here. And now, the point is that even if you look at the poverty line that is coming down, the percentage of people below the poverty line is coming down. Now, what is that number? Whether it's 28% or less, that's a matter of debate. So that's the kind of thing. So what we are trying to say is that your addressable market in 13-14 will be this much. Right? And since you have a very large market here, you will need horses for courses. What it means is that the people have similar type of aspirations. But what they can afford in that particular product category will depend on at what price point you make it available. Are you with me?
Yes, sir.
So if you take a shampoo, for example, shampoo sachet, shampoo bottle, some people will buy it for whatever, 150 rupees. There will also be people, you will also find consumers who would be interested in it if you make it available at 2 rupees and in an affordable pack size. Are you? Yes. So there are lots of things that you can start focusing on once you have some ideas to where the consumers are going. Okay, but that's not the thrust of my lecture today. What's happening to rural market? With over 300 million people will be moving up from the rural poor to rural middle class, if you say that one in between 2005 and 2025. And their consumption levels, and these are all based on some of the surveys carried out by NCAER. We have taken the data and analyzed it and put it. Right from the current urban levels, they will come to the current urban levels by 2017. The overall rural households would also grow. In fact, in the FMCG items, the share of rural demand today is more than 50%. So that's again something which is of great interest. If you are selling tea or soaps or shampoos or whatever. Shampoos is not that much rural demand. Soaps, detergents, tea.
What about toothpaste?
Toothpaste, again, the share of rural demand will not be more than 33%. If my memory is right.
I remember from my Colgate days it used to be about 22. But then
It
they
has
said-
gone up.
Yeah.
I left FMCG sector in 2003, so it's around there. Growth in monetary. Now we have talked about the real economy. There was one question on the
Infrastructure.
infrastructure. Okay, I'll just go back. Yeah. Why did it come down? Which
Well, I
one?
think it's the next one.
He's basically talking about that, long-term saving versus.
Long-term saving.
Yeah.
He's getting
I'm talking
confused
about
with that.
that.
So you said that there will be
Long-term
a-
savings has come down.
Yeah, that's what I was talking about.
Yeah. So what is the problem?
So, since on that slide when you said that the savings will be high, but long-term savings, you
So you will have to do.
So how will
So
it-
then what will you do? Suppose your savings is high
Yeah.
and you need long-term savings.
Yeah.
Then, as a policymaker, what should you do?
Or infrastructure
You
technology.
have to attract them towards long-term savings.
Give better interest on long term savings.
Okay, better interest rate of long-term savings.
Technology.
Currently, if an infrastructure, how can an infrastructure company raise funds? They normally have a special purpose vehicle which will raise the fund. How will it do it? It will have to issue bonds. Now, in India, is the corporate bond market developed? It is not developed. So you have to do something about the corporate bond market. Such that you attract people towards long-term savings. Isn't it?
Yes, sir.
Fine. Yeah. Now, let's look at the monetary sector. We have talked about the real sector, what is happening to your GDP, real GDP, savings. All those savings rate and investment rates are as a percentage of real GDP. So, all those are things which you can touch and feel. Now, we are talking about money. If you look at money supply, okay, it is growing at around 18%, bank credit had come down, it's still continuing at around this level, non-food credit is around 23%, prime lending rate is still very high, around 12% has come to 11.5% recently. So that's the kind of picture. Now, last year there was a fear of inflation, no? Because fuel prices were going up, your what you call the commodity prices were going up. When all these things go up, what happened? The immediate response of Reserve Bank of India is to curtail the money supply, curtail the credit, and raise interest rates. And once you do that, what happens to industrial production? Industrial production comes down. That's exactly what happened. What happens to investment? You postpone your investment plans because you do not have either you do not have the funds or you do not have the wherewithal to service that kind of interest rate. So that's exactly what happened. Okay.
So this fall in bank credit to 17.5%,
Yeah. Certainly.
then how do we explain the growth in the industrial sector that we still have today? It's quite a
bank
sharp.
credit came down. If you look at our IIP growth, IIP growth had come down dramatically. It became almost negative and then it has picked up. In the last 2 months only you have more than 7%. So with a lag it started affecting the IIP growth quite badly.
Okay. So recovery has just started.
And it's only after post the stimulus package
Right.
when banks become a little more liberal with credit
Right.
and interest rates started coming down.
So this is primarily because of the impact from the recession impact.
Yeah, absolutely. Now, if you look at, we have got two indices of inflation, of which one is WPI, the other is Consumer Price Index. There is also a Consumer Price Index for non-manual workers and all that, and for agricultural workers. I am not getting into that. This is for the industrial workers and the wholesale price index. Now the two seem to differ in their measure of inflation rate. Now, what I want to bring to your note is that food articles, where the major inflation is taking place, the weightage in WPI is 15.4%. In here, it has got 46%.
Yeah.
It's almost 1:3. Right? So if food prices go up by, say, 10%, you will see a 4.6% inflation here and 1.5%. And food prices of late has gone up by more than 12%. So you can see the difference. So this is what is happening. Your food prices are going up because of the weighting scheme. This is showing very low inflation, whereas in CPI we are seeing 11.6%. Right?
Yes.
So now, when you go to industry, and there may be some people amongst you who will be joining the HR group, okay, and will be sitting in all these negotiations, or even if you are in the finance sector, you will be sitting in all these negotiations with the industrial labor. Okay, your cost of living index or DA will be paid on the basis of CPI. Okay. Now, what happens is, when you have this negotiation, there is always a tendency on the part of the trade unions to tell you that you must introduce all the new things which are there in the market as a part of our consumption basket. Okay? Because they think by that the DA will go up. Okay? Now, look at the new things which have been introduced in the market and which form a very substantial part of your household budget today, which was not there 5 years back or 10 years back. One of them is mobile phone. The rates are coming down. One of them, in the 80s when we used to do this negotiation, they always wanted to put chicken and that's poultry and eggs in the basket. We said yes, by all means put it, because when the poultry sector expanded, that's one area where the price growth has been much lower. You see, compared to everything else. So the point is, if you have a sector which they want to include and in which technology is driving that sector, anything which is driven by technology, the prices come down. Are you with me?
Yes, sir.
So, you put it.
TV चाहिए तो दे दो.
So, that's there is absolutely no problem. They tell you to put it.
So we have learned something. How we negotiate next year. Say Gupta sir.
I'll give you a DVD player now.
So, the other thing is, we have done some research in this area which shows there is some relationship between inflation and growth rate. Up to 5% growth and up to 5% sort of inflation rate, you can find growth is still going up. There is no adverse impact on the growth rate. But subsequently, if it goes beyond 5%, it starts coming down. So that's something which you may like to keep in mind when you do the strategic planning for your companies.
Siddhartha, these dots are the actual data points. That is
Yeah,
the curve
yes.
is right.
Yeah. This is a fitted. Now the other thing is what is happening to interest rate. I have taken a 10-year GSEC, government security. Yeah.
Then till 2006, we had both even a growth rate was high and inflation was high. How come you said?
No. Well, where did you see the 2006?
No, till 2006, year 2006.
Inflation was not high. Inflation was quite down. Inflation was high. It was very much within 5%. Inflation started going up in 8-9. Yeah. If you look at interest rate, this is 10-year GSEC, the government security. It is in August it was 7.14. Today it's about 7.3, 7.4. That's the kind of interest rate that's found out. Now let me ask you one. Why do you think the government? Everybody talks about developing the corporate bond market. There has been a lot of reports, Raghuram Rajan committee report, and earlier also there have been several reports talking about developing the corporate bond market. But why do you think the government is not all that keen on developing it?
The government bond market will go down.
Exactly. If you have the private bond market developed, then what happens to the government securities which they have to sell? That's one of the major issues. And the banks will then start, instead of parking the money in government bonds, they will start putting it in private bonds. So, apart from whatever else you have in terms of, when a corporate gets bankrupt, who has the first charge? Our corporate, the bankruptcy laws are not very clear. So that's another thing which is preventing the investment in corporate bonds by outsiders and some of the corporates which have got risk-related norms. Now, you may like to know a little bit about the global meltdown. Okay. What is the linkage of global meltdown with India? That it affects the growth of trade, funds flow, GDP growth, investor sentiment. The overall impact was however limited, and in India the key drivers of growth still remain. The two key drivers of growth are domestic consumption and domestic investment. Okay. Now, if you look at the GDP projections of US, there are three sources: IMF, EIU, Economist Intelligence, and World Bank. This is the kind of projection they have. One thing you need to remember, which is the second part of the slide. If 2008 was your 100, to go back to the 2008 level, you have to go up to 2011. So we do not see a very clear recovery till 2011. That's something, though people have been talking about on a quarter to quarter, there has been a pickup on growth, etc. Maybe the worst is behind us, but we are still not there where we were in 2000. Are you?
So we can say it's a U-shaped recovery.
Whether it is U-shape or W-shape, that we will see subsequently, but I am not getting into that. All we are saying that in 2011, you have to be, till that time, you have to be cautious. Now, if you are an Indian industry which is trying to export to US, you have to build this kind of downside into your calculation. You are doing this right, you're planning for it. Are you with me?
Yes, sir.
Yeah. Now, you look at what is happening to other economies. That is EU growth rate, the UK growth rate, Japan, South Korea, China, India, Indonesia, all these things are there. But growth rates don't give you the entire story. Let us look at the base. This is what is happening. In EU, it is 2013. In UK, again the same kind of a story. Japan followed in 2012. South Korea a bit earlier. China and India and Indonesia continue to do well. So this is the story. One of the countries that we are missing out on is, no, Brazil is not doing that. It's Indonesia. Okay, so a part of our exports can be focused towards. It doesn't appear in the so-called BRIC. Now, if the world GDP goes down, Indian exports also suffer. So that's nothing unusual. Then coming back to India's external trade. So basically, what I'm telling you is that things may look up, but don't expect too much before 2011. That's the time. Exports as a percentage of GDP is 14%. Imports are 24.5. Total trade is 38.9. Then you have the net services trade of 7.7. So if you do not take the net but the gross inflow and outflow, then this number will not be just 46.6, it will go to about 60%. So that is the degree of openness of the economy, which essentially means you are a lot more open today than you used to be in the past. So if you think that there will be a global meltdown and I will not get affected, that is not true. Then, what is the direction of our exports? You can see one thing. You take Europe and North America. It used to be 42% in 0506, 24.16 and 17.82. You add up, it's around 42%. That has come down to Europe is 22 and then 13, so about 35-36%. So there has been a compositional change. Whereas you can see the other parts, Africa's unspecified region, all that would be increasing. Not CIS. Africa has gone up considerably. Asian countries have also gone up. So in this we have been sure. Now the other thing is funds flow. Okay. I'll tell you a story on funds flow a little later. If you look at Sensex and Financial Times index, you will find that both are moving in the same direction. The correlation is quite high. The same thing is true of Sensex and Nikkei, maybe a little less. If you put it with Dow Jones, that's the kind of thing. The same thing with Hang Seng. Now the point I'm trying to make is the capital markets internationally are getting integrated. Funds will flow from one part to another. Now what is happening today? Again, our markets have started going up. What is happening today you find a lot of FIIs are investing in India. Why is it happening? One of the things which is happening is money is available in the West at a very low rate. Interest rates are coming. And dollar as a currency is weak. So if I want to borrow in dollars, what should I do? If I am a euro market operator, I should go to New York and short the dollar. Dollar will come down further. So I borrow at a negative rate of interest. Are you?
Yes.
Once you borrow at negative rate of interest, even if you bring it at a positive rate of interest, that is also very good. If you bring that to a country which is giving you 17-18% return in the stock market index on a long-term basis, you make a huge amount of money even after hedging for the currency risk. Okay. So that is what is going on. So you borrow, bring the money, make the money here, then again take it back. Earlier you were waiting for some time. Now periodically you will find that it is coming down because you take some money out. And again when it goes up, or when it comes down further, valuations are good, you will bring some money in, again take it out. That's the kind of thing which is happening. Now, this net FII flows had become 15 billion negative in 0809. It has turned positive, it is now 13 billion positive. The other thing through which we get money is external commercial borrowing. External commercial borrowing almost became less than about 55-60%. It came down by. That's the kind of thing which happened between 0708 and 0809. Now that external commercial borrowing has again started going up because rates are high, rates are low, and there used to be earlier a risk premium on emerging country borrowing that is no longer there. So as a result, this has started going up. 0809 was a very bad year for external commercial borrowing. FDI has started going up from 22 billions to 34 billions. 0809 was 35. This year it's expected that it will be about 40 to 43 because we already have seen a very huge growth. Now, what is this FDI? No, that's true. This is an investment. Earlier when we talked about foreign direct investment, we thought these guys will invest in brick and mortar sort of an industry. They will start a factory here, they will employ people and do all kinds of things. Now FDI is largely private equity. They are buying off your private equity, and the way private equity, the nomenclature goes, it has to be for a slightly longer time than your FII, and at least 10% of the equity of the company will have to be taken, so then it becomes a private equity. So it's again a financial investment. It is not a brick and mortar investment, most of the cases. So that is your FDI, but funds are coming there. So that's the. So I have now covered almost a wide range of topics. I'm sure you people have some questions which I will answer, try to answer. And thank you very much for the
Question on this FDI, like the FDI in India is constantly increasing. But again, there's a risk, like for example, if the FDI, the money is withdrawn, again our market, our economy will be largely affected. So, don't you think there should be some regulation on FDIs also?
In FDI coming in?
Yeah.
No. What is the problem? Suppose you need the fund.
Yeah.
If they can bring it in.
Like me, what happened in this recession is because a lot of money was withdrawn by foreign investors.
That is not FDI. That is FII. Now in FII, some countries have started imposing what is known as Tobin tax on the capital inflows. They allow the capital inflows freely. When you want to take it out, there's a 2% tax. Brazil is one of the countries which is put that. Now the point is, then your capital market may not get the required funds in. What these required funds are doing, they are also raising the level of the index. So if you are coming up with a new equity issue or a rights issue or a sort of a private placement of your equity, etc., the rate at which you can issue it in the market is normally much higher than what it would have been otherwise if FII investment was not there. So as a result, what is happening, your ability to raise capital, that is to say domestic sector's ability to raise capital has gone up a lot. So that's the indirect impact of it.
So what is the lock-in period?
If you put a tax, they will not bring it. They will go somewhere. You can have some procedural norms by which you can prevent them from taking away money very rapidly. You allow them to take the money out, that's not a problem. But you can create sufficient bureaucratic hassle by which they have to take it out in phases.
We can create some time frame, like after that only they can withdraw.
That RBI can do quite easily. That we do not need. Yes, you have.
So there is no lock-in period for FDI?
No?
Lock-in period for FDI?
FDI is for long term. FII there is no lock-in period.
FDI, what is lock-in period?
That is, so you basically, when you get into the private equity sort of a route, that's the idea you are asking for.
Yeah.
Because brick and mortar, you have to sell that factory and all that, that will take years once you have put it in. In FDI, if you take your private equity, you have to have more than 10% equity. And to sell off 10% immediately, the market will be very difficult. Because prices will crash.
Yeah.
Once the prices crash, you don't get the kind of money which you
So the gap between manufacturing sector and service sector is widening in terms of growth as well as absolute term. Is there any correlation between these two, or it's okay whatever the gap is? How will it affect us if there's a huge gap? It's more.
You see, after all, who buys your manufacturers? It will be the people employed in the services sector. So long service sector is generating demand in the economy, what is your problem?
So service sector will act as an engine and that will do the manufacturing.
That will help the manufacturing sector. That's one. Secondly, when you bring services sector in the tax net, when you have this GST, the goods and services tax, the integrated one, then they will also be paying you taxes. So what is the problem?
Somewhere I had read that our service sector is booming and the base manufacturing is not that strong. Somewhere it's wrong.
No, the base manufacturing is that whatever you require, most of the things are manufactured here in this country. Earlier, there were some restrictions on imports. Now, I do not have a chart. I would have shown it to you on the competitiveness of the Indian economy. You know, when 92-93, we opened up our economy and our customs duties came down from, the peak customs duty came down from 150% to 10%. Everybody said, 10% last year, everybody said that Indian manufacturing is going to close down because they do not have economies of scale, their technology is outdated, they do not have the best practices, all. And which are the sectors which are going to close down? Engineering and chemicals. If you look at Indian exports, the two sectors which have done marvelously in last 10 years, more than 10 years, from 90 to 93 till about 7, 8, so about 15 years. These two sectors are engineering and chemicals. Both have grown at 17% plus. So obviously we must be competitive in that sector. Otherwise, how are we? So it's not entirely true that our manufacturing is today. You take anything. You take say an automotive component. Okay, the upper threshold price is determined by the landed cost of import. You see, because you cannot charge more than that, because otherwise you will get competed out of the market, isn't it? So that way it is not. Say 5 years back, if you had said Indians are going to export cars, people would have laughed at me. They said, Indians, they will export cars. In last 5 years, that's the sector, automobile sector, has grown, their exports have grown at the rate of 36% per annum. 36% per annum. That's the kind of growth. So it's not true that Indian manufacturing is non-competitive. We did some study between India and China. Where we are problems. Problem is because of the tax component in our case is quite high. It doesn't get an offset because of the way our value-added tax are sort of structured and all that. If the GST comes, at least 17% of the disadvantage as a percentage of the total value of that item will get knocked out. So we'll be a lot more competitive. The other thing is that interest rate cost in China, there is hardly any interest cost, nobody knows what Chinese interest rates are. So that's one, and that their power cost and utility costs are much lower. But our tooling cost, designing cost, etc., all these areas we have an advantage. Yes.
Sir, as you know, as there is data that our fiscal deficit is 8 to 10% of our GDP, how sustainable is it? How sustainable is it?
Yeah. You see, if you look at our central government's sort of deficit, it used to be 4.4 sort of a thing, which has gone to 6.5%, of which 6.8%, of which 1% is because of the stimulus package, the rest has gone up because of subsidies, etc., etc. Then there is some off-balance sheet sort of a deficit. This off-balance sheet deficit is because of this peculiarity of 0809, you have to do certain things. So there is to the oil companies, you have to give some oil bonds, to the fertilizer companies, you have to give certain things, etc. So that off-balance sheet. And then there is a state deficit. Their total deficit is around 2.5%. So if you add up all this, it comes to 10%. Now, if you look at UK's fiscal deficit, that is also 10%. Okay. Because 0809 was an exceptionally bad year. So it went up. It will get sorted out. Once the economy moves up, tax collections will go up. Right now, tax collections are not going up that much because the economy is still picking up. If the GST is introduced, then a large part of the service sector will be in the debt. So that will also raise the tax collection. If you look at our tax GDP ratio is going up. And if you look at the tax GDP ratio of the earlier years, you will find there is a preponderance of indirect taxes. Now indirect taxes have come down, direct taxes have gone up, services taxes are going up. So as a result, we are moving in the right direction.
So, but disinvestment would help the disinvestment.
Disinvestment will give you some money. Now the question is, you have some family sales. How do you sell it? You sell it when the prices are very high. So you have to enter the capital market at the right time. Disinvestment in small amounts, say 5%, 7%, etc. One is to accept disinvestment as a philosophy that I don't want to be in this sector, the government, why private sector should stay. The political sensitivities are such that you don't want to go for that. So what you want to do is to raise some money out of it. Then you should enter the market when it suits you most.
So, as we've seen that our economy has been very strong, But the stock market, on the other hand, with any repercussion around the world, it always shows a different picture of our economy. And is it important that only the stock market shows the face of the Indian economy, or
You see, at the end of the day, any stock market, the growth in that will have some relationship with the earnings in the companies. It cannot be in complete isolation from the earnings of the companies. If you look at the index growth on a long-term basis for last 15 years or so, you will find that stocks have given you about 18% kind of a return. If you look at the kind of earnings growth in companies, the well-performing companies which are there, it's about 50-60%. There may be 2-3% because of something else. The rest is because the earnings are going up. Because it cannot be in isolation from the earnings on a long-term basis. On a short-term basis, yes, funds come in, funds go out, there will be some fluctuation, etc. Because you look at some of the companies which used to be brilliant companies 15 years back, Century Textiles. What is Century Textiles today? There are lots of such companies. Some of the companies which were not there in the horizon, in the audio radar screen, Infosys. Where was Infosys 15 years back? Nobody knew about it. Even 10 years back, nobody knew about it.
So, facts make it evident that we are on a recovery stage from the recession. So, I would like to know your views on is it a U-shaped recovery, V-shaped, or W-shaped?
You see, what I showed you, that to get to the same level, it will take a couple of years. Now, in between, there could be fluctuations, because in the initial part of any recovery, there is some inventory adjustment which takes place, which has possibly already, the impact of that we have already seen. Now, whether it's going to pick up, we are not very sure of that. You look at it this way. In US, what has happened? In US, consumption has come down. Savings rate has gone up to 5%, right? The third thing which has happened in US is imports have come down. When the imports come down in US, the country which gets affected most is China, right? So, in China, there is a lot of spare capacity which is available. Not only spare capacity is available in China, people who were part of the Chinese supply chain, countries in Southeast Asia like Malaysia, Vietnam, Indonesia, they also have a lot of spare capacity. So they can export things on an incremental cost basis. Once they start exporting on an incremental cost basis, what will happen to Indian industry? Because the landed cost of these will be will determine the upper threshold for the domestic. So Indian industry will start getting affected. Now India has gone and signed this ASEAN agreement, which will become implementable or which will get implemented next year. So all these things will start coming. So that will have an impact on your manufacturing. It's not going to go up in a hurry. Of course, within WTO, you have some clauses like safeguard, which can do, if you can prove it is going to do a serious damage to our industry, then we can put in that safeguard. On soda ash, there is a safeguard. The other thing is anti-dumping. Anti-dumping is very difficult to prove because you will need the cost data. So, all these things you have to consider very carefully. So it is not just U-shaped or W-shaped or V-shaped, it's a little more complicated than that. Yes.
Sir, in today's economic times, I read about the cap that government RBI is planning to put on foreign borrowings. What is the impact that's going to happen on the corporates?
You see, foreign borrowings at any point of time you will have to pay it back. So you must have the capacity to pay back. That your profitability has to be such. Okay, if you look at it in a macroeconomic perspective, what happens is that your GDP growth rate, always, the real GDP growth rate has to be higher than the real interest rate. Otherwise, you will get into a mess. Here also, you have to see the amount that you are paying back and the amount that you are earning. That there is a good amount of difference between the two so that you can pay it back. That's one. Secondly, what happens if when you are paying it back, you have sort of taken a huge amount of loan and Indian currency depreciates. You have to pay back a lot more. So are you earning that much? So it has to have some kind of a check and balance.
So our friends are sitting in that room, they are watching you. So, another class.
Our class next to also the polycarp, the machine is actually building your lectures there.
So they have asked, they are saying some questions.
Okay.
They asked that why isn't it the base year for the calculation of inflation being changed from year 93-94 to a more recent year? Is the calculation really accurate? Yes, this first question.
No. Yes, I get your question. You see, what happens whenever an index is computed, you try to put the most recent basket into place, and on the price indices are computed on the basis of the weightages of each of the items in that basket. So between 93-94 and today, our composition of goods consumed have changed. A lot of things which were not there, take mobile phone which was not there has come in, so you also like to put that. The other thing which is being seriously considered is that today neither in CPI nor in WPI services are taken into consideration. But services are now a very major part of the economy as well as of our consumption. For example, you are studying here, this is education service. So it's not considered. Or school fees, they are not considered. Now, all this, there has been a lot of discussion as to whether we can put services into the thing. The new index which is going to be there, unfortunately, will not have services. But that's how it's being done.
The second question is bailouts and the stimulant package. Public sector debt has increased and dollar is depreciating. Is there any there is a global debate that the dollar should be substituted with other currency. What are your views on that?
You see, before you say the dollar has to be substituted by other currencies, let's look at what are the other currencies. If it would take SDR, for example, there is something called DOLEX, dollar index. Now, if you take dollar index, in that dollar itself, which is for the entire currency, even in SDR, the dollar weightage is very high. In some of the cases, the weightage, because there are a number of currencies, the dollar weightage itself is 57%. So, the rest of it is much less. That's point number one. Point number two, many currencies of the world are related to dollar because of currency board and others. So, de facto, it's the impact of dollar that there is. So, it is not so easy to replace. Take euro. With what will you replace? Take euro for example. In Europe, what is happening? Europe is considered to be one currency area. There is a major difference between what is happening in Germany and France and what is happening in South Europe, like Italy, Spain and Portugal. They want to increase their money supply or have a lax fiscal policy because they have to create employment, which essentially means that will have an impact on Europe. Whereas Germany and France are relatively better off, particularly Germany. They do not want anything to be changed. So Europe, though we say is a single currency area, sovereign interests are different. So euro can never be a very strong currency. The only option is to look at SDR. But even in SDR, if you take the overall weightage of various things, the linkage with dollar is very strong. So how do you replace dollar?
Could we be looking at Chinese currency in the long run?
If you look at Chinese currency in the long run, 2-3 things. The acceptability of the currency. China has been trying to push this. In fact, they want to do some yuan trading in Southeast Asia. They wrote to the SBI chairman, the bilateral trade between India and China can be determined in yuan. Indians are very much against it because that will give them political advantage. So Chinese currency as such may not be very acceptable in the region, leave alone